The Iran conflict has pushed markets into a sudden wave of fear. Oil prices surged, gold reached new highs, and volatility spiked across global markets. But history shows something important. The best long-term investment opportunities often appear when fear is highest. Today we will combine geopolitical analysis with two powerful sentiment indicators to understand where we may be in the market cycle. The conflict began on February 28 when joint U.S. and Israeli strikes targeted Iranian military infrastructure. The biggest concern for markets is the Strait of Hormuz, where roughly 20% of global oil supply passes through. Within days of the conflict, oil prices surged sharply, gold reached record highs, and global equity markets moved into a risk-off environment. But when analyzing markets, the key question is not simply what happened. The more important question is how much fear is already priced into the market. Two indicators help answer that question: the VIX Volatility Index and the CNN Fear and Greed Index. Currently, the VIX is around 27, which indicates elevated volatility, but not yet full financial crisis conditions. Meanwhile, the Fear and Greed Index sits near 20, a level classified as extreme fear. When extreme fear appears together with elevated volatility, markets often enter a contrarian opportunity zone. Instead of trying to predict the exact market bottom, I prefer using a sentiment-driven allocation framework. During the early panic phase, my preferred approach is often to hold more cash. Cash provides flexibility while markets remain unstable. As fear stabilizes, investors can begin accumulating sectors that were oversold during the panic. Examples include airlines, consumer discretionary companies, and Asian semiconductor supply chains. These sectors often rebound quickly once geopolitical uncertainty begins to stabilize. The most important signal in this framework is volatility compression. When the VIX begins falling toward the low 20s, market panic is usually starting to fade. Historically, this is when growth sectors begin leading the next market rally. Technology stocks, semiconductors, and large growth companies often outperform during this phase. Markets rarely wait for the news to improve. They often begin recovering before headlines change. Even after a conflict ends, some sectors may benefit from long-term geopolitical changes. Defense spending may increase, cybersecurity demand often rises, and global energy security initiatives may accelerate. These sectors may continue benefiting even after markets stabilize. The key lesson from history is that markets tend to recover from geopolitical shocks faster than many investors expect. Instead of reacting emotionally to headlines, investors can use sentiment indicators and volatility trends to guide their decisions. When fear is extreme, patience and discipline often create the best opportunity. And when volatility begins to decline, that is often when the next market rally begins. Thank you for watching. I share these videos as part of my personal market research process.